Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Let's take a look now at some of the stories we're tracking for you in the BNN Bloomberg newsroom. While retail sales across the country came in stronger than expected in November, data from StatsCan, strong receipts rose 1.3% compared to the month before, driven by higher sales at food and beverage retailers. The agency also noted that sales were up in 7 provinces, led by Alberta, on higher sales as well on motor vehicle and parts dealers. In a flash estimate for December, though, StatsCan says retail sales will likely fall 0.5%. Shares of NVIDIA, Advanced Micro Devices, and Taiwan semiconductor manufacturer all up today, anywhere from 1.6 to 3.25%. Bloomberg reporting that China has told the country's largest tech firms, including Alibaba, that they can get ready for orders for NVIDIA's H200 AI chips. This seemingly suggests that Beijing is close to formally approving imports of components essential to powering artificial intelligence. Shares of Intel are taking a hit, though, as the company struggles to keep up with surging demand from AI data centers. It's now down by more than 14%. The chip maker has cited supply chain challenges along with delays in transitioning to a new semiconductor manufacturing process as key obstacles in the fourth quarter. The decline follows a strong 2025 when Intel's stock rose nearly 50%, boosted by major investments from SoftBank, NVIDIA, and the U.S. government. And taking a look at the markets right now, you can see the TSX up again, resuming its upward trend, and it's close to a record high, a close at least, up over 33,000 right now. South of the border, it's a bit of a mixed bag. You can see that the S&P 500 is back up again, up by about a quarter, but the Dow is off by 0.4%, and the NASDAQ is up by 0.71. All right, Canada's latest retail sales numbers are up 1.3% for November after a deal was reached in BC to end a labor dispute that affected the province's liquor distribution branch. Let's get more insight on this from Norman Levine. He is portfolio manager of Brook Wagman Private Wealth Management at Raymond James. Norman, thanks for joining us.
Welcome from Aruba.
Is that where you are?
I'm dressed.
I'm looking at the T-shirt. It's a casual Fridays taken to the extreme.
Right in from the beach. So retail sales were up in the month, but it's very deceptive because they were led by the first group that led it was beer and wine and alcohol and spirits, and then the second was food. So you've got booze prices going up, which are causing that to happen, or people spending more. And Canada has the highest in food inflation in the G7 by a lot. So that's why your prices, your retail sales went up. It's a very bad number other than that. And it shows that the Canadian economy, especially compared to the US economy, is actually stagnant with signs of inflation, which I don't want to use the word too casually, but is it the first signs of stagflation? Possibly.
What are some of the numbers that are giving you that indication?
Well, if you've got food inflation up over 7% year over year, and you've got sales basically flat when you take out the booze sales. So to me, economy not growing for the consumer, and the prices that consumers are paying are higher. I'm not looking at total economic pricing, that hasn't been reported yet, but retail sales, that's just showing that the possibility of stagflation is there, whereas in the US, you've got an economy doing better and projected to do better. So they're not having the same issues that we are here.
And the prediction for December, I think, was down. Sales would be down for December. How do you bring that in, and what does that mean?
Well, okay, so once again, you've got sales coming flat or down and prices staying stickily high. That doesn't portend well for the average Canadian consumer who is hurting. We've got, as I've talked to you about in the past, we have a K-shaped economy where the well-to-do and the boomers are, I'm one, but the boomers are doing well, whereas younger people are struggling to get jobs. They're struggling to pay for rent and homes and for food. And that doesn't portend well for the economy.
All right. And people are looking for places to go with their money. Gold right now is up. Just looking, it's back. It's closing in on 5,000. Not quite there. It's still up for the day. How are you treating that right now?
Well, I have some representation in the precious metals. Silver has gone parabolic, and it scares me, but parabolic moves can go a lot higher than people expect for longer before coming crashing down. But people are moving into precious metals because they're afraid of all the government spending going on and afraid of interest rates, long-term interest rates going up because of that. So the way I'm playing it is I don't own an individual mine. That I've learned from 50 years in the business that owning individual mines or mining companies can be dangerous even when the commodity is going higher because of problems that can happen at individual mines or in countries where they're located. So I own Franco-Nevada, which is a royalty, which gets royalties from other companies' production in gold and silver. They're also into energy and some other commodities as well. So it's not as dramatic as the moves in gold and in silver, but to me, it's a lot safer place to be.
And where are the royalties coming from? Are they mostly North American or all over?
Roger, they're around the world. The company was started, and the reason it's called Franco-Nevada is they were getting gold royalties out of properties in Nevada, but now it's a worldwide company getting, as I said, royalties on gold, on silver, but also on iron ore and on crude oil and some other metals, copper, et cetera. So it's a good way to play without a lot of individual risk.
And you're starting to turn towards small caps as well right now.
So small cap, when I first became a portfolio manager in the early 1980s, and for the next 10, 15 years, I managed small and mid cap portfolios. I learned that there are times in the cycle, economic cycle, market cycle, when small cap stocks outperform and times when they underperform. And I also learned that buying individual companies takes a lot of work that most investors aren't prepared or can't do. You have to really kick the tires on individual companies, meet with management, go see their facilities, see if they're for real or not. And then you go through periods when the companies do well, the stock does nothing because nobody cares. So I've discovered that it's better to own the small cap indexes rather than individual companies. And I'm playing the IWM, which represents the Russell 2000 in the US. And it has underperformed the S&P 500 for 14 straight years. And so the valuations on small cap stocks are much lower than large cap stocks. And they are now starting to outperform for the first time in 14 years. So I still think it's pretty early going for them. And what's behind that is they've benefited from lower interest rates, from lower energy prices, and also from the fact that the vast majority of them are domestic in nature. They're not multinational like most of the companies in the S&P 500.
Okay.
And with the U.S. economy doing better than people expected, with tax refunds coming to people, I expect that the U.S. economy, especially for individuals and for smaller companies, is going to do well. So that's why I'm recommending owning IWM. I don't know if your people were able to get the chart together that I was looking for, showing either the Russell 2000 or the IWM and versus how the S&P 500's been doing.
We couldn't do it, unfortunately, but we're also out of time right now, Norman. Thanks very much for joining us. We'll let you hit the beach right now. Enjoy the break down there and the weather. You're not missing much up here right now. So
no, thank you, Roger. Stay warm.
We'll try. Norman Levine is portfolio manager at Brook Wagman Private Wealth Management with Raymond James. Coming up, Intel takes a tumble after reporting weak first quarter guidance. We'll take a closer look after this. Intel beat in its fourth quarter, but shares are under pressure after the company reported a weak outlook. For more, we were joined earlier by Matthew Bryson, Managing Director of Equity Research, covering enterprise hardware at Wedbush.
Intel, last quarter, they told us that they were going to be more constrained in Q1, that they just weren't going to be able to ship out of inventory. So revenues are going to be down. When revenues go down, that has an impact on gross margins, and that's what played out. If there was anything new, it was really, in my mind, that there's this opportunity in advanced packaging that might come about in 2027. It might be more meaningful than had previously been thought. But I think they told you pretty much what they said they were going to tell you last quarter.
So it sounds like they just can't keep up with orders. Is that right?
Yeah, no. So that's their problem. They don't have enough capacity. In particular, you're seeing a ton of demand from large customers for server compute, and Intel can't produce enough chips, and they've been shipping out of inventory. So satisfying customer demand with already produced product, and they just don't have any more.
And who makes the product that they sell? Is it manufactured by Taiwan Semi or somebody?
No, in Intel's case, it's coming out of their own fabs on the server side for the most part. So they are constrained by their own manufacturing capacity.
Now, your thesis, I think, if I got it right, is we've seen disappointment today because Intel had this big run-up prior to these numbers. Maybe we can put up a one-year chart again.
I mean, that's exactly it. So I think there was this hope that as Intel gets 18A up, so they start running chips on their own facilities, and instead of having to buy as much content from TSM, that as that node becomes more competitive with what's out there from TSM, that you start seeing margins on those new products begin to look like old Intel margins when they were doing, 60, even 70% gross margins on some products. And I think it's just too early.
Obviously, the perception has been that they're at risk of becoming an also-ran in the AI chip-out market. What are your thoughts on that?
I think that they are already an also-ran. Now, having said that, when you look at what AI is going to drive, right, it's driving more demand for traditional compute, so they still benefit there. That's, in fact, why they have a shortage of server compute right now. And at the device level, it drives demand for more intelligent PCs, smartphones, what have you. And I think they have opportunities there. So I think they benefit from AI. But I think for them to actually be a player in terms of supporting AI, competing with the likes of NVIDIA, that's going to take a whole lot of development work. And we're a long ways away from anything happening on that kind of set of products.
What would make you fall in love with Intel stock or get you switching to a buy?
It's really seeing gross margin improvement and competitive improvement with their new sets of products. So, it's Panther Lake is their first product out on the PC side, but some of the new server products as well. seeing kind of continued trajectory higher in gross margins, which would suggest that, yes, they're finally catching back up to TSM, but we're at the start of the journey and you just can't see it in numbers yet.
And he was speaking with Matthew Bryson, Managing Director of Equity Research covering enterprise hardware at Wedbush. Coming up, we have some mixed readings on Canada's retail sector. I'm Lindsay Biscaya. We'll sort it all out for you right after the break. We are getting some mixed signals today when it comes to Canada's retail sector. For more on this, we're joined by BNN Bloomberg's Lindsay Biscaya. Lindsay, yeah, the numbers up a little, but not as good as once you start breaking them down, not as good as you want.
Exactly, yes. For the month of November, they are up, as you say, 1.3% month over month, so compared to October. But these numbers show sales are increasing for the month of November, but just barely, especially as you say, when you break it down. Across the country, it was up over 7 provinces. It was up. New Brunswick, it was down the most. Alberta, it was up the most. And what we're really seeing is what's driving these numbers. What was interesting was the food and beverage sector was the main driver here in terms of seeing this number go up, which is interesting because in October, that was definitely not the case for that sector. But beer, wine, and liquor contributed to the biggest jump in sales, up 14.3%. And as I know you pointed out, that's mostly due to a labor disruption in BC in the month of October, which disrupted sales.
People had to resupply.
Exactly. People had to resupply, and then you just see sales jump after a decrease as well. Gas sales up 2%. What's interesting is online sales, relatively weak. They were actually down 2.8%. And when you think of November, that includes Black Friday,
which is interesting.
It's so interesting where you think a lot of people are online. This is one of the biggest kind of cyber shopping days of the year. And we spoke earlier with Randall Bartlett from Desjardins. He kind of explained why that might be the case. Have a listen.
November data will pick up Black Friday sales. And so ultimately, we've seen this move toward buy Canadian and away from Canadians purchasing goods from the U.S. And so no doubt this is probably getting picked up in this data. It's kind of tough to tease out what is the different causal factors here, but we've seen that e-commerce has been relatively weak recently. And so I think it really is partly a function of this buy Canadian tilt by consumers here in trying to support Canadian businesses that have been hit by the trade war with the U.S.
And Bartlett's saying, because inflation is still above that Bank of Canada 2% target rate, it's clear that households still feeling that squeeze very much, and you're seeing that reflected in the numbers.
All right, and what are we expecting for December?
Yeah, so there is a flash estimate out for December, a decrease of 0.5% for the month of December. Assuming that flash estimate is right, that would be a 0.2% decrease in the fourth quarter of 2025. So obviously it just shows people are not spending as much at the end of 2025 as they were at the beginning of 2025. But when you look at what happened throughout 2025, it's not a surprise, right? I mean, it's hard to remember a world before this trade war, to be honest with you, and before these tariff talks every single day of the week. But that's where we started out at the beginning of 2025. People were a little bit less concerned, a little less, that uncertainty wasn't there that we've started to see with consumers throughout the end of 2025. And
can't wait till we look back in 2026.
Yeah, it's going to be a year, I think.
All right, we'll leave it there. Lindsay, thank you. BNN Bloomberg's Lindsay Biscaya. Well, Canada remains Las Vegas' largest international visitors market, but recent reports show a significant decline in Canadian travel. So in an effort to try and bring Canadians back to Sin City, select hotels are offering to take Canadian money at par. For more on this, we were joined earlier by CTV's Scott Hurst.
Las Vegas is definitely a destination. Of course, this time of year, there's the climate. It is much warmer, but also, as you pointed out, there are the gaming options and all the entertainment options. But for much of the past year, we've seen these travel numbers have been pretty consistent, that Canadians, not just Las Vegas, but have shunned a lot of travel to the United States. And now some U.S. hospitality chains are obviously looking to grab some headlines, at least north of the border, with promotional stunts to lure us back across the border. And at least one Sin City hotel chain is rolling the dice, gambling that Canadians will come back for a good deal. 3 hotels in Vegas are now accepting the Canadian dollar at par for select gaming, hotel, and drink services, with this promotion running through the summer, with the goal at least to remove the financial barriers for Canadians wanting to travel again. As we know, many Canadians have pointed to the weak loonie as a reason for not crossing the border, but also the political climate, as a new Abacus poll has shown. 1 in 4 Canadians, about a quarter of respondents to the survey say they've avoided travel to the United States, Andrew, because of feelings towards U.S. President Donald Trump.
The latest numbers I've seen are for November, and apparently trips by Canadians to the U.S. and back were down 24% year over year.
Andrew, these numbers just out from Stats Canada for the month of November, and you're right, almost 24% decrease in overall trips returning from the United States for Canadians. And to break that down even further, between car trips and plane trips, return trips from the U.S. by car declined more than 28%. Those are often trips, of course, right across the border, often to those border states. And in November, return trips by Canadians by air was down more than 12%, but that doesn't mean Canadians aren't traveling. We've seen, at least anecdotally, a lot of Canadians have decided to travel across this country, keeping our tourism dollars in Canada, but also to many other places around the world, as these latest numbers from Stats Canada also point out that Canadian resident return trips from overseas countries by air actually increased more than 14%. So it shows Canadians aren't just staying home. They are still traveling, just not wanting to go to the U.S. right now for the political climate and, of course, the dollar exchange.
And that was CTV's Scott Hurst. When we come back, the president of the C.D. Howe Institute with a forecast on interest rates for the Bank of Canada. That's next. Canadian retail sales rose 1.3% in November compared to the month before. According to Stats Canada, the increase was led by gains at food and beverage retailers. Core sales climbed 1.6%. I spoke to an economist on what these stats say about current Canadian spending habits.
We've seen that retail sales have really just sort of been a bit of a zigzag pattern sideways throughout the year after a very strong acceleration in 2024. So ultimately, Canadian consumers, spent a lot last year. There's a lot of reasons for that. HST, GST holiday, motor vehicle rebates, particularly for EVs. And so ultimately, Canadians, given all of the uncertainty and the relative weakness in the labor market, we've seen Canadians just sort of, stay on the sidelines.
Shares of Bausch Health are under pressure. They're down 10% after the company failed 2 clinical trials. Both trials tested a better form of the drug rifaximin to see whether it could help prevent brain damage in adults with liver disease. The company's CEO says they are disappointed in the results and are now reviewing the data to identify new development opportunities. China's ambassador to Canada says allowing a limited number of Chinese electric vehicles into the country could lead to new auto jobs and cheaper cars. The comments come as Ottawa faces criticism over a deal signed by Prime Minister Mark Carney and Chinese President Xi Jinping. Ontario Premier Doug Ford recently urged Canadians to boycott all Chinese EVs. Ford says the vehicles put thousands of auto sector jobs at risk. And looking at the markets for today, you can see the TSX now into record territory. It's up by 0.4% right now, 33,134. The high on Monday was 33,090, so we'll see where it ends up at the end of the day. And south of the border, a little bit of a mixed bag right now. The S&P 500 up by 0.17, the Dow off by 0.5, and the Nasdaq up by 0.5. The C.D. Howe Institute is calling for the Bank of Canada to maintain its overnight rate at 2.25%. For more on this, I'm joined by Bill Robson, President and CEO of the C.D. Howe Institute. Bill, thanks very much for joining us. Why the call to leave things alone?
It's a remarkable contrast between the kind of volatility in the discussion, points of uncertainty with respect to the economy and certainly the political environment. And yet, when it came time for the group to make its recommendations, there was a strong consensus that the path of inflation in Canada is toward 2%. The softening in the economy kind of puts it where the Bank of Canada would like it for hitting the inflation target. So after dealing with all the volatility and all the uncertainty and the big questions, the group really was very much of one mind on that, at least in the near term.
And what are your worries if they went either way, if they cut or if they raised it? What would be your concerns?
There was a sense among a lot of the members, they expressed that if they had to move at all, they would move down. But there wasn't a lot of enthusiasm for a cut. Only one member recommended that over the course of the coming year. And I think that's because there's still a lot of caution about the fact that inflation is above target. The bank's core measures, people have different views about how useful they are, but they're also showing much more strength. And when you look at certain types of things that are happening in food prices, everybody notices that. With the population numbers changing, there are some businesses that would be feeling a pinch on the labor side. And then there's been a bit of an acceleration in some of the measures of money and credit. So nobody was all that eager to see the Bank of Canada cut either because of the danger that inflation might not actually be licked. They liked it where it is.
And we just had the retail numbers come out today. How would you describe the Canadian economy? Delicate, fragile? How do you feel about it?
Well, consumers are looking pretty tapped out. I mean, the monthly number was strong, but that followed a couple of very weak monthly numbers. And if you look at the chart that StatsCan publishes, where they not just give you the nominal growth, but real growth, you can see that retail sales are really going nowhere the last little while. And we've also got from the Bank of Canada quite recently their consumer confidence survey, which shows that people are not feeling great. They're feeling pinched. They're concerned about the weakening labor market. So some of those things that made the Monetary Policy Council members comfortable with the current level of the overnight rate are clouds over the consumer. It's worth mentioning also there's going to be a lot of mortgage rate resets coming up over the next year. So it doesn't look as though the consumer is going to be a source of great strength for the Canadian economy. Wasn't coming out of 2025 and into 2026 either.
And are you seeing anything that might drive the economy this year, if it's not consumers?
It's interesting to see where the equity markets are. I mean, when you look at the contrasts between how people are feeling and then how some businesses are doing, I might say among the Monetary Policy Council members, there was a lot of concern about where the CUSMA negotiations are going, with Donald Trump throwing something new and different at us every day. But if that negotiation works out, preserving a lot of the market access that we now have, and we're seeing a lot of strength in materials, some of the areas of the Canadian economy that are quite strong, then in fact, Canada might be doing relatively well over the next little while. I might throw in quickly, because people are looking at these major projects and some of the pro-investment talk that's coming out of the federal government. It'd be nice to have that, but nobody's counting on it in the near term. We're not really seeing a lot of action. We're hearing a lot of noise, and we're seeing a lot of large numbers in terms of dollar signs, but it's going to be a while before any of that comes through.
And of course, south of the border, you've got the push from the White House and around the president to cut rates. Does that put any pressure up here, do you think, on the BOC?
I think it doesn't in any direct sense. The Bank of Canada's independence isn't under threat. But if you think about where this might lead in the United States, there could be some problems for us, or at least some challenges for the Bank of Canada in steering a straight course. You can see that the bond market's nervous about what's happening with the Fed. So if long-term interest rates in the U.S. go up, that's going to put upward pressure on long rates globally. And then if you get a very wide gap between the Bank of Canada's short-term overnight rate and what's happening with longer-term yields, that can be a bit of an accelerator for monetary policy. So that might induce the bank to raise the overnight rate a bit. And if you do actually see higher inflation in the United States, that implies a stronger Canadian dollar over time. And people often get uncomfortable about that. So yes, it would create some navigation challenges for the bank.
And we have seen the American dollar weakening in the last couple of weeks. Any indicators that's going to continue with the policy happening south of the border?
There's a bit of a U.S. off mood in markets right now. And you'd have to be a very brave person to go all in on the United States, because every morning and sometimes late at night, Donald Trump does throw something else at us. I myself, if I were betting on it, would say the Fed is going to come through this relatively unscathed. But the threats are very clear. And with U.S. fiscal policy as hyperextended as it is, something's got to give at some point. And so there's a natural concern that what gives is suddenly the Fed gets forced to start buying a whole lot more debt, and that leads to inflation.
Okay, Bill, we'll wrap it up there, but thanks as always for joining us.
My pleasure. Thank you.
Bill Robson, President and CEO of the C.D. Howe Institute. Coming up, we'll get more on the latest record rally for precious metals. That's next. Well, silver has topped $100 an ounce for the first time ever, extending a scorching rally. Gold is also flirting with $5,000. Let's hear more on this from Kenneth Hoffman, head of commodity strategy at Red Cloud Securities. Kenneth, thanks very much for joining us.
Thanks for having me.
After the kind of wild surge at the end of the year, we thought maybe things will cool off, but nothing has changed. Is that good or bad? We'll talk silver first. Is that good or bad on where we're seeing silver? I think it's at just over $100 right now.
Well, I mean, I think what's going on in the world today, and this is something a year ago we wrote at Red Cloud, $10,000 long-term gold prices, and I think people thought we were a bit nuts. But what we saw is that a decline of the dollar, which had slowly been occurring for the last 20 years in terms of the percentage of gold used in global trade, that when the Trump administration came in, they were just going to pour gasoline on top of diesel, on top of everything, and just really explode the acceleration of the decline of the dollar. The trade wars, the constant chaos, and we call it chaos is normal now. All of these things are driving foreign investors to sell the dollar and buy gold. Not only investors, but more importantly, central banks, who have figured if I'm not trading so much in dollars, I don't need to hold those dollars. I want to hold something else, and gold is that area. Now we've seen a follow-on with silver and even some of the platinum, palladium group metals, as a lot of investors, particularly in China, see silver as a lot cheaper to buy. It's also a hard asset, and so they're gobbling that up. Silver's not as liquid as gold, and so it's really seen a rocket here to $100 an ounce.
And you see the bull run continuing for how long? You're talking 10,000. When are you thinking about that, and what might derail that?
Well, I think I'm looking at it in terms of gold bull markets. There's been two gold bull markets really over the last 50 years, from 72 to 79. The U.S. came off the gold standard. There was a revaluation of gold, which hadn't changed its price in 60, 70 years. And we saw an 1,800% move in the price of gold. Again, in 2001 to about 2010, we also saw around an 800% move in the price of gold. That was China coming onto the world market and really sort of starting this story of dollar devaluation and other currencies coming to fore. So we think we're probably only in year two of what could be another 6 to 8 years of a rally. And if we were to do anything between those other two gold bull markets, we're starting at about 3,000. Going to 10,000 would be sort of a disappointing bull market. Going much higher than that would be sort of a normal gold market. So we think this is a long way to play out. The daily moves are sort of uninteresting, but the long-term move of much, much higher gold prices, I think, is inevitable. And again, only occurs the more the U.S. acts the way it has been acting in the past year.
So what might derail what derailed the last two? What ended those runs?
Well, I think medium term or even short term, what derails it is the U.S. elections in the second half of the year, if they were to occur. Who knows what happens here? But I think you're going to see a lot of the sort of chaotic moves by the Trump administration, at least into June, July, maybe August. But then the market's going to say, wait a second, if the U.S. Congress shifts sharply towards the Democrats, they'll be able to put a kibosh on a lot of what Trump is trying to do. And that would probably slow things down and probably be a negative for these markets. And so that would be sort of the next milestone I would look at, is how do the markets view the U.S. election in November of this year?
And then see where we're at with that. Is this kind of a new gold standard? Can you call it that in a way?
It truly is. Now, remember the Basel III agreement, which just came into effect a couple of years ago, classified gold as a full tier 1 asset. So it is a currency considered by central banks around the world, whereas before that, it was only considered a half an asset. So for every dollar, say, I put into gold, immediately on my balance sheet, it was only counted at 50 cents. And so there was a disincentive for central banks to own gold, and a lot of them sold a lot of their gold because of that. Now with the new Basel III arrangement, it is 100%. And so a lot of the central banks are saying, hey, I want to own gold here, and they're shifting massively. I think Poland right now, 27% of their central bank's reserves are in gold. And in fact, the second largest share holding of currencies, and I do consider gold to be a currency, of all the central banks in the world, number 2 is gold, right after the dollar. And I think as the dollar continues to drop, gold will continue to rise.
Okay, and then with silver, it's a lot more volatile. I mean, there's a need for it, especially with the AI boom that's going on. What do you see? How do you see silver going over the next little while?
Well, again, silver short term is really going parabolic. I think it's what we're hearing is an awful lot of demand out of China, so expect a lot of volatility. The thing I don't like about silver is, unlike gold, which is just pure money, obviously jewelry and other applications, but it's really money. Mm-hmm. Silver has a lot of industrial uses, and particularly in solar. And you could see silver start to price itself out of the solar industry, and I think you're already starting to see out of some of the Chinese figures it's doing so. That would be good for some competing materials, particularly scandium, actually, which some of the European solar producers use instead of silver. So you do have to worry about some substitution risk. And then if the Chinese investors in particular come off of the boil a little bit on their silver holdings, you could see some quite choppy markets there in silver. So buyer beware there.
Okay, we'll have to wrap it up there, but Kenneth, thank you very much for joining us.
Thanks for having me.
Kenneth Hoffman is head of commodity strategy at Red Cloud Securities. Coming up, Prime Minister Mark Carney's speech in Davos earlier this week is still spurring reaction, including from U.S. Commerce Secretary Howard Lutnick. We'll take a look at the implications right after the break. Prime Minister Mark Carney's speech in Davos earlier this week still spurring reaction, including from U.S. Commerce Secretary Howard Lutnick. Lutnick had pointed remarks for Carney and what he described as whining from Canada. Here's CTV's Michael Couture on what it could mean for trade and CUSMA negotiations.
Give me a break. They have the second best deal in the world. And all I got to do is listen to this guy whine and complain.
U.S. Commerce Secretary Howard Lutnick called the Prime Minister's speech in Davos political noise. Tuesday, Mark Carney urged middle powers to band together against more powerful countries that use economic coercion. Lutnick warned those words will be remembered during this summer's trade review.
They have USMCA, which means 85% of the Canadian economy comes into the United States for zero. And there he is complaining that he's going to go to China and improve it.
Canada's finance minister pushed back on those comments.
Prime Minister said a lot of things that people thought, and he had the courage to say it loud. I think Canadians have understood by now that diversification is key.
Meanwhile, the reverberations of Carney's message continue to be felt with other world leaders.
I think we have a lot of Europeans who are in this first camp of multilateralism, whereas the American administration is driving multipolarity. And we're trying to make these two things meet.
Australia's treasurer called the speech stunning, adding it makes a powerful point about the old world order being over.
So the job for us, the job for our Canadian friends, is to work out how we can shape all of this change in our own interests.
California governor and possible Democratic presidential contender Gavin Newsom also praised Carney at Davos for calling out the current state of the world, adding Americans need to do the same. Michael Couture, CTV News, Ottawa.
And yesterday, the Prime Minister spoke to the nation, addressing how middle powers have to work together in today's uncertain economic times. For more on what Canada's trading priorities look like and why Donald Trump revoked Canada's invitation to join the Board of Peace, we spoke with Bryden Teich, CIO, a portfolio manager at Avenue Investment Management. Have a listen.
I think I echo the comments from the pack. I think like it was a great speech from Carney. I think it's interesting to see how much reaction it's getting because he's basically just describing what is happening. Mm-hmm. And I think but we did it in a very articulate way. I think that, and again, with everything else that's happened this week, I think it makes it newsworthy. He's just describing what the U.S. is doing and what China has long done, which is essentially flex itself through economic means to get what it wants, to have more power, in the world. And I think to see, Lutnick, his comments, and then, like, it's a kind of a charade at this point. I mean, ultimately, Canada and the U.S., we need to work together. I don't think there was a whining aspect to Carney's speech. He's just describing that countries that are in the middle have to figure out, firstly, their own interests and get those right, and then figure out how, if there's a way for middle powers to work together, because the concept of the UN or the World Bank or the World Trade Organization, like these things are not functioning organizations. That's just a reality. And so I think being able to articulate that, or seeing a prime minister articulate that very clearly, I think it frames for Canadians, like, we do need to figure out what our priorities are. And I think so far, his administration and his parliament is attempting to do that, which I think is a positive.
Could we see a kind of middle country economic union of some type, not just, you have the EU, but from around the world? Or are we too drawn to China and the U.S., especially in Canada?
Yeah, I think we're definitely, the global economy circles around the Chinese and U.S. relationship, and everyone is either then a second or third trader with the U.S. or vice versa with China. And ultimately, that is the core global economic relationship, the U.S. and China, that matters. Mm-hmm. I think, in many ways, I do agree with what Doug Ford is saying about Chinese EVs bringing to Canada. I mean, effectively, the Chinese are just producing as much as they can at full blast, and they're trying to find countries to dump it on. And so, not to say that there aren't agricultural exports from Canada that China needs, and there's some sort of balance there. Ultimately, we need to get to a path to working productively with the Americans. Is it going to be in this administration in the U.S.? Maybe, maybe not. But I don't think Canada can go too far into a different reality that doesn't involve having a core economic relationship with the U.S. And it would be, as a Canadian, I think we would all appreciate if there was a little bit more sort of, level-headedness from their side on this. Yeah. But clearly, Canada and the U.S. need to be partners.
Maybe there's some level-headedness behind the scenes with other players involved in it. But I mean, we just saw he disinvited Carney from his board, the Board of Peace. And all this, of course, is shaping up as we head into CUSMA. It's a difficult game Carney's playing because, I mean, he's told everybody that we're going to have new business from elsewhere. But the reality is, I mean, our border and the U.S. are still essential. A vast majority. Yeah, it's so important to us.
Well, we're planning my 4-year-old's birthday party in February, and this sort of disinviting friends seems very familiar with what's going on. And I mean, it's like, again, it is a game. It doesn't really matter. I don't even know what this Board of Peace is. I think most people would overlook it anyways. So, not to dismiss it as trying to fix what's happening in Gaza, but ultimately we do need to work together with the Americans. I think that there's a level-headedness in the private sector, certainly in both countries, and I think that this sort of ongoing political charade that plays out from the American side, I don't think is positive. I think Carney and what his government is doing, I think is trying to thread the needle as productively as possible. And I think, it's been a long time since you had Canada, at a global conference like that, sort of almost steal the headlines. And I think having a leader being able to communicate the economics of interests of Canada is something we definitely haven't seen in more than a decade. And so it's nice to see that, we have a leader who at least can understand the game better than maybe what we were seeing in the past 10 years.
Pretty much everybody, I'd say. So what, from an investment point of view, with everything that's unfolding, where do you look? What do you do?
Well, I think the one thing that is, again, a key theme from last year and this year is, I think you take tariffs, but go at a bigger level. For all countries, there is this refocus on, your core domestic economic priorities. I think where Canada can pivot, and you're seeing this in what was released in the budget, is increase in defense spending and just getting to NATO target. And then I think the target is, or the goal is, to get up to 5% of GDP per year by 2035. Okay. Like, these are enormous levels of spending if they were to materialize. And I think there's But again, these are just, they have to go from being a budget document or parliamentary document to
happening.
Working with the private sector, getting investments done, and starting that process happening. And I think Canada, it's essential that we do that.
That was Bryden Teich, CIO and Portfolio Manager at Avenue Investment. Market calls coming up next. Today on the show, we have David Driscoll. He's President and CEO of Liberty International Investment Management, and we'll be taking your questions on global stocks. All right, let's take a quick look and see how the markets are doing on Bay Street and Wall Street. First up, we'll start on the TSX, and it is in record territory right now, looking at 33,000, almost 33,100. If it holds there, that would be a record high, which was, of course, set on Monday. It's up 0.29%. And fueling this are the miners right now. Take a look at some of the big movers right now. Aya Gold's up 7.5%. Pan American Silver, it is up at 3.7%. IM Gold as well, also having a good week. And part of the reason for IM Gold, it climbed on Monday as well after it said it was ahead of gold production for 2025 and predicting more for 2026. So that is what's fueling that right now. And then a quick peek south of the border. Let's see what's unfolding down there. And we can see the U.S. markets. It is a mixed bag as we head into the week. It's been a bit of a chaotic week with everything that has gone on. The S&P 500 up by 0.15. The Dow, though, going to be off by 0.5 right now. And the NASDAQ is up by more than 0.5 point. All right, that is it for us for the morning markets. Thank you for watching us. We'll see you back here on Monday. Have yourself a great weekend. And if you're out in that cold, stay warm.